They didn't ban silver trading. They didn't announce a new law. They didn't warn anyone. But while you were sleeping, they quietly changed one number, $52,000. And that single number just decided who survives the next silver move and who becomes exit liquidity. On your screen, silver looks normal, calm, controlled. But somewhere else in the world, people are paying $140 for the same ounce. Two prices, one truth. And if you don't understand why this gap exists, you will understand it the hard way. Stay with me, because what happens next is where most people lose everything. Welcome to Market Metal. If you are someone who live long enough to know that systems don't warn you before they change, then this channel is for you. Subscribe, not for hype, but so you don't have to figure this out after it's too late. And tell me in the comments, where are you watching from right now? The silent rule change. They did not hold a press conference. They did not issue a warning. There was no headline announcing a ban on silver trading. Yet, in practical terms, that is exactly what happened. While most market participants were asleep, a single number was changed inside the system, and with that change, the structure of the silver market itself was altered. In modern financial systems, power rarely announces itself loudly. It operates through mechanics. Rules are adjusted, thresholds are raised, and participation becomes conditional. Nothing is made illegal on paper, but access becomes so expensive that only a small group can continue to play. Everyone else is removed automatically, without protest, without debate, and often without fully understanding what just happened. This is how markets are controlled in the 21st century. The silver market provides a textbook example. A standard silver futures contract represents 5,000 ounces of silver. At a price of roughly $115 per ounce, that contract controls more than $575,000 worth of metal. Until recently, the capital required to maintain such a position was demanding, but manageable for many professional traders, funds, and experienced individuals. That changed rapidly. In less than 1 month, the maintenance margin requirement was raised multiple times. From a structural perspective, this was not a minor tweak. It was a fundamental redesign of who is allowed to stay in the market. Margins exist to protect clearinghouses from default. That is the official explanation. But history shows that extreme margin increases almost never occur in calm, well-balanced markets. They appear when pressure is already building inside the system. When margins rise, traders must immediately post more cash just to hold existing positions. They are not buying more silver. They are not increasing exposure. They are simply paying to remain in the game. If they cannot meet the requirement, their positions are forcibly closed. This creates a mechanical outcome. Selling happens regardless of conviction, research, or long-term fundamentals. Positions are liquidated, not because traders want to sell, but because they are no longer allowed to stay. In effect, the rules decide the outcome. For large institutions with deep balance sheets, a $52,000 margin is inconvenient but survivable. For smaller funds, independent traders, and non-institutional participants, it is often prohibitive. The market quietly filters its participants, not based on accuracy or insight, but on access to capital. This is why such changes matter far more than most headlines. What makes this event particularly important is timing. Margin requirements are usually raised during periods of extreme volatility, after sharp moves, when markets are unstable. In this case, the adjustment occurred while silver was rising, and while demand for physical metal was increasing globally. That detail changes the interpretation entirely. Raising margins during a falling market is defensive. Raising them during a rising market is restrictive. It caps participation precisely when momentum builds. It slows price discovery by design. To understand why this matters, one must understand how modern markets function. Most price discovery no longer occurs through physical exchange of goods. It occurs through derivatives, futures, and financial instruments. These markets rely on trust. Trust that contracts represent real supply, and trust that settlement mechanisms will function as promised. Margins sit at the center of that trust. When margin requirements become unusually high, they act like toll gates. The price on the screen may continue to move, but fewer and fewer participants are allowed to influence that movement. Liquidity thins, volatility increases, control concentrates. This is not theory. It has happened repeatedly across financial history. In previous decades, access to markets was restricted through licensing, regulation, or direct prohibition. Today, it is restricted through capital requirements. The result is the same. Participation becomes selective. From the perspective of a business owner, investor, or long-term decision maker, this distinction matters deeply. Systems that change rules quietly tend to do so under stress. They do not change rules when everything is working smoothly. This raises the central question of Part 1. Why now? Why would an exchange double margin requirements in less than a month unless the existing structure was under strain? The official explanation points to volatility and risk management. Yet volatility is a symptom, not a cause. Risk does not appear suddenly. It builds silently, often out of sight, until mechanical interventions are required to contain it. Margin hikes are one such intervention. They do not remove risk from the system, they redistribute it. Risk is shifted away from institutions with influence and toward participants with fewer resources. Forced selling absorbs the pressure. Prices adjust. Balance sheets stabilize. For some, others are removed. This process has a long history in commodity markets. In moments where demand for delivery increases, where inventories tighten, or where leverage becomes excessive, exchanges intervene, not to protect price discovery, but to protect settlement. Settlement is the system's true priority. From that perspective, the $52,000 margin requirement should be viewed not as a neutral adjustment, but as a signal. It suggests that something beneath the surface is no longer balanced. It suggests that existing rules were no longer sufficient to maintain order. And crucially, it suggests that access itself has become a tool. Markets are often described as free, but they are only free within the boundaries of participation. When those boundaries shift abruptly, outcomes change, regardless of fundamentals. This is why experienced operators watch rules more closely than headlines. The silent rule change in silver did not make trading illegal. It made it conditional. It raised the cost of conviction. It tested who could afford to stay. For those who understand financial history, this pattern is familiar. Before major transitions, systems tighten. They become less inclusive. They favor stability over fairness, containment over transparency. The silver market is not unique in this regard. It is simply one of the clearest current examples. By the time such changes become widely discussed, the filtering process is already underway. Positions have been closed, liquidity has shifted, control has narrowed. This is why Part 1 matters. Before examining physical markets, delivery data, or institutional behavior, one must first understand the mechanism that set everything in motion. A market does not need a band to be controlled. It only needs a barrier high enough that most cannot cross it. The $52,000 requirement is that barrier. And once a barrier appears, the most important question is no longer where price goes next, but who is still allowed to participate when it does. That question will shape everything that follows. The paper market versus physical reality. If Part 1 explained how the rules were changed, Part 2 confronts a far more dangerous question. What if the price you are watching is no longer real? At first glance, the silver market appears calm. Screens show a clean number. Charts move in familiar patterns. Commentators debate resistance levels and technical signals as if nothing fundamental has changed. But beneath that surface, a fracture has formed. And fractures do not announce themselves. They spread quietly until the structure fails. Across the world, silver is trading at multiple prices at the same time. On paper markets, the quoted price remains near familiar levels. Yet in physical trading hubs, where real metal changes hands, the cost is significantly higher. In some regions, buyers are paying 20 to 25% more for the same ounce of silver. This is not a temporary premium. It is not a shipping delay. It is not a regional anomaly. It is a signal. In normal markets, price differences close quickly. If silver trades higher in one location, traders buy where it is cheap and sell where it is expensive. This process is called arbitrage. It is the mechanism that keeps markets honest. It is the reason global pricing usually converges. But that mechanism is failing. When arbitrage stops working, it means something is broken in the chain between paper promises and physical supply. Either the metal cannot move freely, or the paper contract no longer guarantees access to real metal. Both possibilities carry serious consequences. To understand why this matters, one must understand how price discovery works today. Most silver is not bought or sold as bars. It is traded as contracts. Futures, options, exchange-traded products, and derivatives dominate daily volume. Physical transactions represent only a small fraction of total trades. In other words, the price most people see is not set by people buying silver. It is set by people trading claims on silver. This system works only as long as those claims are trusted. The moment trust weakens, the system begins to separate. Paper continues to trade among itself. Physical begins to trade on its own terms. That separation is now visible. In Shanghai, buyers are paying well above the paper price to secure immediate delivery. In Tokyo, the premium is even higher. In Dubai, demand remains strong at levels that no longer match Western screens. These are not speculative markets. They are commercial centers. When prices diverge there, it reflects real demand, not sentiment. This creates an uncomfortable truth. If physical silver is consistently more expensive than paper silver, then paper silver is being discounted for a reason. And markets only discount what they doubt. Some dismiss this gap as temporary. They argue it will close. They insist that futures prices will eventually rise to meet physical demand, restoring balance. That is one possible outcome. But there is another. Sometimes paper prices do not rise. Instead, physical markets stop caring. They form their own pricing system. The paper market continues to exist, but it becomes informational rather than authoritative. This is known as a two-tier market. In a two-tier market, one price applies to financial instruments. Another applies to real goods. History shows that once this split becomes entrenched, it is extremely difficult to reverse. What makes the current situation more concerning is the context in which it is unfolding. The price gap did not appear during a supply surplus. It did not emerge during weak demand. It appeared during rising global consumption, tightening inventories, and increasing delivery requests. At the same time, the paper market responded not by allowing prices to rise, but by increasing margin requirements. This is critical. When physical demand strengthens, price discovery should adjust upward. When instead the system restricts participation, it suggests price movement is being constrained by rule changes rather than supply and demand. This is where suspense enters the story. Markets can suppress prices temporarily. They cannot suppress reality indefinitely. When physical buyers are willing to pay more, they reveal information that paper markets are trying to mute. Over time, that information accumulates pressure. Imagine two clocks ticking at different speeds. One shows paper time, the other shows physical time. They can diverge for a while, but eventually one must catch up to the other. Which one moves? This question sits at the center of part 2. There's another detail that sharpens the risk. Physical premiums are not being paid by inexperienced buyers chasing hype. They're being paid by industries, refiners, manufacturers, and long-term holders who require metal, not exposure. These participants do not care about charts. They care about delivery. When such buyers accept higher prices, they are signaling urgency. Urgency is never ignored for long. Yet paper markets respond differently. They respond through liquidity control. By raising margins, they reduce the number of buyers capable of holding long positions. This can slow price increases. It can even trigger short-term declines, but it cannot create metal. This is the contradiction now facing the silver market. Paper pricing suggests stability. Physical pricing suggests scarcity. Both cannot be correct indefinitely. When faced with this contradiction, systems tend to choose the path that preserves order. That often means protecting the paper framework as long as possible. But doing so requires increasingly aggressive interventions. Each intervention reveals stress. Each restriction confirms imbalance. Each gap widens suspicion. The suspense lies not in whether this divergence exists, but in how long it can persist. Business leaders and capital allocators understand this pattern well. When accounting numbers diverge from operational reality, something eventually gives. Either assets are revalued or confidence collapses. Markets are no different. At this stage, the silver market is sending two messages at once. One calm, one urgent. The calm message dominates screens. The urgent one dominates physical flows. Most people listen to screens. Experienced operators watch flows. As long as physical buyers continue paying higher prices, the paper price becomes less informative. It still trades, it still prints, but it loses authority. This is why the divergence matters more than any single data point. It suggests that the system is entering a phase where prices are negotiated differently depending on whether one wants exposure or ownership. That distinction did not matter much in the past. It matters now. And when distinctions begin to matter in markets built on uniformity, instability follows. Part 2 ends with a simple but unsettling realization. If the paper price is not clearing physical demand, then something else must. Either price rises or access tightens further. Either confidence returns or separation deepens. Both paths involve disruption. The market is not broken yet, but it is no longer unified. And when unity disappears, control becomes temporary. What happens next depends not on sentiment, but on stress. Part 3 will examine the evidence that this stress is already visible, not in opinions, but in data, deliveries, and institutional behavior that cannot be ignored. Institutional stress signals. Markets rarely break in public. They fracture in private first. Before prices explode or collapse, before headlines change tone, stress shows up in places most people never look. It appears in delivery data, inventory movements, and behavior that seems routine until it suddenly isn't. This is where the silver market now stands. On the surface, nothing appears dramatic. Futures still trade, screens still update, commentators still discuss charts as if this were a normal cycle. But behind those screens, a series of signals has begun to line up. Individually, each might be explained away. Together, they form a pattern that demands attention. The first signal is delivery behavior. Silver futures are designed primarily for price exposure, not physical settlement. Most contracts are closed or rolled forward before delivery. Only a small percentage ever result in metal changing hands. That is how the system has always functioned, until recently. In January, a month that is not considered a primary delivery period, delivery volumes surged. Thousands of contracts moved into physical settlement. This alone would be unusual. What made it alarming was the scale. January became one of the largest silver delivery months on record, despite occurring outside the traditional delivery calendar. This is not a statistical curiosity, it is a behavioral shift. When traders demand delivery in off-cycle months, it means they are no longer comfortable rolling contracts forward. They want metal now, not later. That choice signals declining confidence in future availability. The system is built on postponement. When postponement stops working, pressure rises quickly. The second signal is who is delivering. Large financial institutions began issuing significant delivery notices. This is critical. Institutions typically avoid delivering physical metal unless they must. It ties up inventory, reduces flexibility, and exposes balance sheet constraints. When major players deliver large quantities in short periods, it suggests position management under stress. It suggests short exposure being reduced. It suggests risk being closed, not extended. This is not speculation. It is observable behavior. Institutions do not voluntarily give up metal during periods of rising demand unless holding it has become more dangerous than releasing it. That danger can come from one place only: future delivery obligations that may be difficult to meet. The third signal is inventory depletion. Exchange vaults exist to reassure markets. They are the visible proof that contracts are backed by something tangible. When inventories are stable, trust holds. When inventories drain rapidly, questions follow. In recent weeks, large amounts of silver were withdrawn from registered inventories. Not over years, not gradually, in concentrated bursts. Registered inventory represents metal available for delivery against futures contracts. When it declines sharply, it reduces the system's margin for error. It means fewer ounces are standing behind a growing number of claims. This matters because futures markets rely on confidence, not just math. If participants believe delivery will be honored, they accept paper settlement. If doubt enters that belief, behavior changes. And behavior is already changing. The fourth signal is leverage imbalance. Modern commodity markets operate on leverage. For silver, the imbalance between paper claims and physical supply has grown extreme. Hundreds of paper ounces exist for every ounce of real metal. This structure works only if most participants never ask for delivery. The moment even a small percentage does, the system strains. That strain is now visible. When leverage becomes excessive, exchanges face a choice: allow price to rise and risk losses for short holders, or restrict participation to reduce pressure. Margin hikes are the preferred tool. They are immediate. They are mechanical. They do not require explanation, but they also reveal urgency. Exchanges do not double margins casually. They do so when they fear cascading failures. When volatility alone is cited, it is often incomplete. Volatility is tolerated when settlement is secure. It becomes unacceptable when settlement is threatened. This brings the story to its most revealing signal: timing. Margin increases occurred as physical demand strengthened, not weakened. Delivery requests rose. Inventories fell. And rather than letting prices rise to ration demand, the system raised the cost of holding positions. This is not how healthy markets respond. In healthy markets, price absorbs pressure. In stressed markets, rules absorb pressure. That distinction defines the moment. There is historical precedent for this behavior. In previous commodity squeezes, exchanges intervened not to facilitate discovery, but to slow it. They restricted buying. They raised margins. They limited participation. Each time the justification was stability. Each time the effect was the same. Weak hands were removed. Strong hands consolidated control. The underlying issue remained unresolved. Eventually, it surfaced anyway. What makes the current situation more suspenseful is the global context. Silver is not a regional commodity. It is a global input. Industrial demand spans continents. Energy systems, electronics, medical devices, and infrastructure all rely on it. When physical buyers across multiple regions signal urgency simultaneously, it cannot be dismissed as local noise. Add to this the role of geopolitical constraints. Export controls, refining concentration, and supply chain nationalism have tightened flows. These forces do not show up on price charts immediately. They show up in availability. Availability is what delivery data reflects. At the same time, paper markets continue to trade large volumes with little friction, for now. This coexistence creates the illusion of stability, but it also masks the growing disconnect between what can be promised and what can be delivered. Institutions are acutely aware of this gap. They monitor it continuously. When it widens, they act. They reduce exposure, they deliver metal, they raise margins, they protect balance sheets. None of these actions are designed to help price discovery. They are designed to survive. From the outside, this may look like normal market management. From the inside, it looks like containment. The suspense lies in how long containment can hold. Delivery demand cannot be negotiated away. Inventory cannot be printed. Leverage cannot expand forever without consequence. At some point, one of three things happens. Prices rise to ration demand. Settlement rules change, or confidence breaks. Each outcome carries risk. Each shifts cost from one group to another. The institutions closest to the system always move first. Their actions are rarely announced. They are observed after the fact, in data that only later gains attention. That is where the silver market now finds itself. Stress is no longer theoretical. It is measurable. It appears in off-cycle deliveries, inventory drawdowns, margin interventions, and shifting institutional behavior. None of these guarantee an immediate outcome. Markets can persist in tension longer than expected, but tension has a cost, and the longer it is suppressed, the more violent its release tends to be. This is why Part 3 matters more than opinion or prediction. It shows that something is already happening, not loudly, not publicly, but decisively. The question is no longer whether the system feels pressure. The question is who is positioned to absorb it when it finally moves. Part 4 will address that question directly, not by forecasting prices, but by examining what these stress signals mean for capital holders who must decide how, where, and under what rules they participate next. Strategic implications for capital holders. When systems come under strain, the most important decisions are not made by traders. They are made by capital holders. This is the point where the silver story stops being about price and becomes about positioning. Up to now, the signals have been mechanical, rules changed, prices diverged, deliveries surged, inventories drained, institutions adjusted behavior. None of this required prediction. It only required observation. Part 4 asks the question that follows naturally from those observations. What does this environment do to capital, and who does it favor? The answer begins with access. By raising margin requirements to extreme levels, the system did more than manage volatility. It quietly redefined who is allowed to participate. A $52,000 maintenance margin does not just reduce risk. It removes entire categories of participants from the market. Small funds, independent traders, family offices with limited liquidity. Even some professional operators are priced out. This is not accidental. High margins act like financial gravity. They pull participation toward institutions with balance sheet flexibility and away from those who must manage cash carefully. Over time, this concentrates influence. Concentration changes outcomes. When fewer players can hold positions, price movements become more controlled. Liquidity thins. Volatility spikes when pressure breaks through. Markets become less representative of broad sentiment and more reflective of institutional necessity. This is why rule-based markets often feel calm just before disruption. There is another structural shift occurring beneath the surface. The move from fixed dollar margins to percentage-based margins changes the mathematics of participation entirely. Under this system, the higher silver rises, the more cash is required just to maintain the same position. Success becomes increasingly expensive. This creates a paradox. In a rising market, long positions are punished mechanically. The more correct a trader is, the more capital they must deploy to stay correct. Eventually, many cannot. They are forced out not by being wrong, but by being undercapitalized. This dynamic favors entities that can absorb rising capital demands indefinitely. It also discourages sustained upside momentum in paper markets. From a strategic standpoint, this matters because it reveals intent. A system that penalizes price appreciation through escalating requirements is not neutral, it is defensive. Defensive systems seek to slow outcomes they cannot stop. At the same time, physical markets operate under a different logic. Physical ownership does not require margin. It does not trigger liquidation. It does not demand additional capital as prices rise. It does not respond to rule changes inside exchanges. This asymmetry is critical. It means the same asset behaves very differently depending on how it is held. Exposure through paper instruments carries rule risk. Ownership does not. Capital holders understand this distinction instinctively. Throughout financial history, moments of structural stress have pushed capital toward assets that minimize dependency on intermediaries. This is not ideology, it is risk management. Intermediary risk becomes visible when rules change quickly, when access tightens, when settlement mechanisms come into question. Those conditions now exist. This does not guarantee a single outcome. Several paths remain possible. One path is repricing. Paper prices rise to meet physical reality. Margins stabilize, pressure eases, trust is restored, at least temporarily. Another path is bifurcation. Paper and physical markets continue to separate. One price applies to contracts, another applies to metal. Participants choose sides based on objectives. A third path involves confidence loss. If delivery becomes uncertain or settlement rules change, paper markets lose authority. Price discovery migrates elsewhere. Each scenario carries different implications. None require speculation to recognize. They follow logically from structural stress. What unites them is direction. They all reduce the influence of leverage. They all increase the value of certainty. They all reward positions that are not dependent on rule continuity. This is why long-term decision makers focus less on short-term volatility and more on framework stability. Volatility is survivable. Rule changes are not. From a strategic perspective, the most dangerous assumption in such environments is that the future will resemble the past. Systems under stress rarely behave predictably. They behave defensively. Defensive behavior prioritizes containment over transparency. This is where suspense becomes real. Not because collapse is guaranteed, but because adjustment is unavoidable. Something must give. Either access loosens, prices adjust, or confidence shifts. The longer the system resists adjustment, the sharper the eventual transition tends to be. Capital holders do not need certainty to act. They need asymmetry. Asymmetry exists when risk is limited on one side and open-ended on the other. In the current silver structure, leverage faces tightening constraints while ownership faces none. That imbalance is not ideological. It is mechanical. This is why capital reallocations often begin quietly, not through headlines, but through flows, through delivery requests, through inventory withdrawals, through premiums paid without negotiation. By the time narratives catch up, positioning is already complete. Part 4 does not offer prediction. It offers framing. This is not a moment defined by charts or forecasts. It is defined by architecture, by who sets the rules, by how quickly they change, and by who can afford to operate under them. When architecture shifts, outcomes follow. The silver market is sending a clear message to those willing to read structure instead of price. Participation is being filtered. Risk is being redistributed. Control is being concentrated. For capital holders, the decision is not about timing tops or bottoms. It is about choosing exposure that does not depend on a system that is actively rewriting its own rules. That choice will define who absorbs the consequences of what comes next. Because when systems enter this phase, wealth does not disappear. It moves. And it rarely moves toward those who trust the rules will stay the same.